second method of handling uncollectible accounts, which is called the allowance method. So as I had mentioned previously, the allowance method is a little more complicated, but it is more widely used and more widely accepted as an accounting practice. All right, and the reason for that is something called the matching principle. So a business is expected to match expenses in the same year that that expense occurred in order to produce a sale, if that makes sense. So if you remember from the direct write-off method, it didn't matter when we sold something to somebody. Whenever we determined that the account was uncollectible, we just wrote it off then. So we could have sold them the merchandise a year ago, 2 years ago, 3 years ago. Didn't matter, right? Very simple. But that violates the matching principle. So we need to, in 2020, figure out how much of our accounts receivable in 2020 is going to be uncollectible. And there's really no great way to predict that. Well, we will go through some methods of estimating that, but that's why this method occurs. Okay, so we will still have the same uncollectible accounts expense account that we used in the direct write-off method, only we're only going to use it one time per year on the last day of the year. And I will explain that pretty soon. And then we're going to have this new account called allowance for uncollectible accounts. Okay, so here you have on December 31st, the starting line estimates that its uncollectible accounts expense for the year ended December 31st to be $1,350. And again, we'll go over a couple of methods on how they came up with that $1,350. So they are debiting the uncollectible accounts expense for the entire amount. Then they're creating this account called the allowance for uncollectible accounts. All right, so remember that expense accounts are closed at the end of the year, right? So I guess you could think about it maybe a couple minutes after this account is debited here, this uncollectible accounts expense, it's going to be closed, right? Because expenses are closed, they're temporary, so we could start at zero. However, this allowance account is a permanent account, so it's going to carry over into the next year, all right? And that'll kind of make sense here as we go. All right, and then there's the same journal entry, not too complicated. Okay, so then that brings up something called the book value of accounts receivable. All right, so when we make a balance sheet, let's go right there, that we have our accounts receivable, okay, but we have less the allowance for uncollectible accounts. All right, so this is on a balance sheet. So hopefully you know that allowance is a contra account. So we still list the total of accounts receivable. Here's that $1,475 worth of uncollectible accounts. And so the book value is what's remaining. Okay. So that's how that works there. And again, there's the explanation of the account being closed. Okay. So this transaction says that on April 18th, after many attempts to collect the amount owed, the starting line decides to write off the account of Megan Sullivan for $150. Okay, so here you look, we instead of debiting the expense, which we would have done in a direct write-off method, now we debit that allowance account, okay? And then we can credit accounts receivable for Megan Sullivan. Okay, so that whatever we created up here, that allowance account for $1,350, it has a credit balance, right? Now when we need to use it, we can debit the account instead of debiting an expense. We debit the allowance and we credit the accounts receivable for that specific customer. Okay, so it's like hopefully it's making sense. At the end of the year, you take, at the end of year 2020, let's say you take one giant expense for all the uncollectibles you think you're going to have, and you create that allowance account. And you use that allowance account during 2021 when something does become actually uncollectible. Okay, so hopefully that makes sense. And then there's the journal entry for that. So just as we did with the direct write-off method, sometimes you could receive payment from a customer that was previously written off. So it's the same process, right? We reverse what we did. So we would debit the accounts receivable for the customer again, and then credit the allowance account, and then record the cash received as normal, right? So debiting cash and crediting accounts receivable. All right, so I'm going to stop there, but these are going to be the next video of the different ways we can determine where did that $1,350 come from. Okay, how did they know $1,350? Okay, and those two methods will be the next part.